Have you ever considered buying property in Hong Kong? If yes, I'm sure you once doubted whether it is still a good investment today. Given the gross rental yield is just around 1 to 2%, should you buy it or just rent it? Some said owning a property makes you poor. Today, let's dive into this topic. Make sure you watch it till the end because I will share the most important factor that I've learned when I was investing in properties in Hong Kong and the UK 5 years ago. Before I start, make sure you hit the like and subscribe button if you're interested in knowing more about my career transition, how is it like working in an investment bank, and upcoming investment opportunities. If you live in Hong Kong, I'm sure you know that the Hong Kong property market experienced a boom since mid-2008 for about 10 years. That's why the older generation thought that investing in property is the only way to get rich. If we look at the CCI index, which included all the transaction records from the land registry, you will see that after the 10 years of bull market, the price fluctuated from 2018 to 2021 and then experienced a significant 14% drop in 2022. Now, looking back, we knew that the drop is probably due to COVID-19 travel restrictions, rising interest rates, and also the outflow of population due to immigration to other countries. So you may ask, what is my answer to this question? Should I buy a property in Hong Kong? If I were you, I will ask these two questions instead. When should I buy a property in Hong Kong? How should I decide where to invest? Let me explain and share my answer in the next 5 minutes. When it comes to investing properties, many people say that location is everything. Location, location, location. Well, I agree that location somehow determines its valuation. For example, properties with MTR stations nearby, convenient amenities, growing populations, and also business activities nearby would help to enhance its valuation. Another factors that we often talk about is the quality of the property. For example, which floor is it on? What is the directions? What is the view? How high is the repairing costs? And who are the developers? Look, properties are very different from stock investment. Every property has a different interior and view, making them being valued very differently. If you ask me, these are important factors, but not the most important. When I decided to invest into the UK property markets 5 years ago, the most important concept that I've learned is to understand and calculate the net ROI, the net return on investments. Now, why is this figure so important? It's because it's basically the net return that you will receive out of these investments. It is basically a percentage return that takes your rental income, deducting all the expenses, and divided by the money you have invested into the property. All the expenses, such as mortgage payment, management fee, home insurance, letting agent fees, utility bills, etc., should be deducted from your rental income, divided by the total amount of money you have put into this deal, which would include down payments, legal fees, stamp duty, estate agent fees, and renovation costs. Only by doing so, you will know that whether this property is earning you money or is costing you money. For example, if you buy an 8 million Hong Kong dollar property and then you put down 50% down payment and then borrow the remaining 4 million at a 3.5% interest rate for 30 years, your monthly mortgage payment will be around $18,000. Suppose you pay $240,000 for stamp duty, $80,000 for estate agent fees, $200,000 for renovation. It would add up to about 4.52 million Hong Kong dollars. If you earn a monthly rental income of $15,000, your total annual income would be about $180,000. Upon deducting your monthly management expenses, landlord insurance, and maintenance fees of about $20,000 per year, and mortgage payment of $216,000 per year, your net rental income would be actually a negative figure of $56,000 per year. Now, divide that negative net rental income figure by the total amount of investments, your net ROI will be negative 1%. A negative net ROI figure basically means that the property is actually costing you money to maintain it. While if it is a positive figure, it's obvious that it is earning you money. You may ask, who will calculate in this way in Hong Kong? If so, no one will be earning a positive net ROI. Well, This is actually the cruel reality that no one wants to point out. But calculating net ROI is what we have learned from the book Rich Dad Poor Dad. So I suggest you to stay true to yourself. Think about what is your purpose of buying property in Hong Kong. It is perfectly okay to own a property for self-use purpose. Many of us would like to own a property for ourselves. Well, that's what we call 剛性需求, right? Some of the others may also see that owning a property is a way to hedge inflation in the long run. However, if your purpose is to earn a positive cash flow, then you need to be very clear about the definitions of assets and liabilities. According to Robert Kiyosaki, an asset is something that puts money into your pocket, while a liability is something that takes money out of your pocket. Let's take one of my UK properties as a real-life example. I purchased this property for £100 as 100% cash buy. That means there's no mortgage being borrowed for this case. I've paid £3,000 for stamp duty, £4,800 for sourcing agent commissions, £600 for legal fees, and £57,000 for renovations, adding up to a total of £165,400. I earn a monthly rental income of £1,100, which equals to annual rental income of £13,200 per year. Since I'm running a social housing strategy for this property, the social housing provider will manage the tenants for me, pay all the utility bills, council tax, and internet Wi-Fi costs. Upon deducting my expenses on the letting management fees, building insurance of total £1,920 per year, my net rental income is £11,280 per year. Dividing that net rental income by the total amount of capital that I've invested in, the net ROI for this UK property that I've invested in is 6.8%. So here comes the second question. How should I choose where to invest? Now you should know the answer, depending on whether the property will provide you a good net ROI. Now, what does it mean by good? A simple rule of thumb will be about 3% above your time deposit rate. So for example, if your time deposit rate is about 4%, then your net ROI figure should be about 7%. That would justify the time cost you spend on researching the data, dealing with the agents, and also the risk that you take in investments. And the net ROI figure should be at least 5%. I had a random opportunity to learn about investing in the UK property markets about 5 years ago, and the concept that I learned about net ROI completely shifted my mindset. It was then when I learned about, as an investor, we should not limit ourselves to a specific market, but instead we should look for investment opportunities that meet our investment objectives with positive net ROI. Instead of letting your personal opinions drive you, it's better to let the facts and numbers speak for yourself. Like many people, they're concerned buying overseas properties as full of challenges. We call it 隔山買牛. But I kept an open mind for it and instead focused on how to tackle these challenges. Look, there's no free lunch. If you are able to earn the money, it's because you have done something that other people couldn't or they didn't do. Now you may ask, the UK property prices has already gone up a lot, especially after the UK launched the BNO immigration policy. That is why the key point here is not to copy my past success, but instead to utilize this net ROI concept to find your next investment sweet spot. Apart from investing in the UK property markets, this year I will be also exploring the Australia and New Zealand property markets. So stay tuned for further updates. Investing in a new market is an exciting and rewarding experience. Still, remember to do your own due diligence very carefully. Always seek professional advice, do your own research, and also assess the potential risk before you make this investment decision. So that's all about this video. Remember to hit the like and subscribe button. If you're also interested in learning more about stock trading from an institutional perspective, feel free to follow my Instagram. Bye for now. See you next time.